Hello, my name is Beatrice Pina. I'm part of the EFSD team. For this project, the mentor and product owner is Dr. Masood Sajjadi. During this brief video, we're going to be covering the scalping strategy as well as some basic terminology and information regarding trading. So the first thing that we want to look over, what is scalping? So scalping is a form of trading in which you jump into the market several times within a short period of time. The idea is to take small profits but constant profits, so about 20 pips of profit each time. It's usually done based on the 5-minute chart, and you always have a tight stop loss and a profit taking target as well. So what are some of the key terms that you want to be familiar with before you start looking into trading? You want to know what buy is, which is an opening position in the market when the trend is positive. Sell is opening a position in the market when the trend is negative, and exit is closing your position from either a buy or a sell. A stop loss is an automatic value set to exit the position if the market moves against you, and a take profit is an automatic value set to exit the position if the market is moving in your favor. So in addition to these terms, we also want to know what is an EMA. EMA is an exponential moving average that measures the trend direction of the market for a period of time, usually applying more weight to the data that is more current. So how is the EMA calculated? So EMA is calculated by looking at 3 different variables. We look at the current price, the previous period's EMA, and the exponential smoothing average. So the exponential smoothing average is a constant that you're going to see usually listed in front of the word EMA. It's going to be like the 8 EMA, 13, 21 EMA. That's going to be your exponential moving average. Your previous period EMA is calculated, and that is used within the function to calculate the current period's EMA. Usually you're going to get your exponential smoothing constant times the current price minus the previous period's EMA plus the previous period's EMA. So now that we know a little bit about the trading terminology and what an EMA is, we're going to get into the scalping algorithm that we used in our scalping. So the first thing we want to look at is anchor trend. This is the first trend that you're going to analyze when deciding whether or not you're going to buy or sell. So this is just like a confirmation chart. This is going to let us know where the market is moving, if it's moving in a positive direction or a negative direction. For a 5-minute scalping strategy like the one that we're using, the trade to determine which way the market is moving is based on the 1-hour chart. This trade determines whether to buy or sell. So picture to the left, you have a sell trend. As you can see, the market is dropping, and this can be determined by looking at the 8 and the 21 EMA. So in this cases, if the 8 EMA is below the 21 EMA as pictured, then you're thinking of a selling trend. If the 8 EMA is above the 21 EMA, then you're going to consider buying. You always want to make sure that your charts, your bars, are below the 8 EMA or above the 8 EMA line, depending on whether you're buying or selling. So once you have your anchor trend and you know if the market is trending up or down, you want to make a decision on whether you're going to jump in the market or not, the actual trade. So for that, we look at the 5-minute chart, and we're going to take into consideration the 8, 13, and 21 EMA. Basically, in the picture to the left, we also have a sell picture. So in this case, we are going to jump into the market, but it's going to be a sell. And this takes place when the 8 EMA is below the 13 and the 21. A buy would be in the opposite direction when the 8 EMA is above the 13 and the 21. So how do you decide when to jump into the market? So once the lines have started moving in a downward trend and you have the 8 below the 13 and the 13 below the 21, you want to look at the 5-minute bar. And you want to look when a bar touches the 8 EMA. That's going to be called the trigger bar. When that happens, you count back 5 candles and enter 3 pips below the lowest price of the lowest candle. If you look at the picture to the left, there's a 3 written on the 3rd candle from the left, and the one that's going to be your trigger bar. You always want to set your stop loss 3 pips above your trigger bar, and your take profit is going to be 1 times the risk. If you decide to if you decide to jump only 50% out of the market and then sell your other 50%, then you would change your take profit from 1 times risk to 2 times risk. If you like more information on this strategy, you can always go to our source. It's a YouTube video that we found online that really goes into a lot of detail in explaining this trading strategy. It was very helpful for us. It's something we recommend that you watch, and the source is listed here. I hope this video was helpful. My name was Beatrice Pina, and here you have my contact information as well as the mentor and product owner, Dr. Masood Sajjadi. Thank you very much.